Hi, everybody. Just a quick announcement. This event will begin shortly. We are just waiting for all our guests to join the event. Please be on standby. Thank you. Hi, everybody. My name is Ekant, and it's my pleasure to welcome you to the first edition of KiwiTech's Venture Capital panel this year. Welcome, everyone. So today we have a fantastic panel discussion on the rise of impact investing, navigating socially responsible funding in 2024. And it's followed by 6 high-value growth stage startup presentations. So let's get started with a brief introduction to KiwiTech first, and it is followed by the Venture Capital Panel event discussion. So it's my pleasure to introduce KiwiTech, a one-of-a-kind innovation ecosystem that's home to 500 plus portfolio startups and 300 plus mentors. Everybody committed to supporting innovators globally, and this all began in 2009, when a team of seasoned entrepreneurs who had previously built and scaled a publishing services company for a 9-digit exit decided to start another company to empower startups with innovation. So all in all, we at KiwiTech, we particularly team up with early to late stage startups. This is to support entrepreneurs with 360-degree support in terms of technology, fundraising, mentorship, networking opportunities, and go-to-market strategy. So, without further ado, I would like to invite our panel moderator for today, Mr. Raik Syed, and he's the SVP of Strategic Partnerships, KiwiTech, to start with a panel discussion. Hi there, Raik.
Hi, Khan. Thank you so much for that. Can you see me and hear me?
You're welcome. I can hear you. Yep, we can see you too.
Wonderful. Perfect. Well, thanks for the introduction and thanks for giving that background of KiwiTech. So good morning, good afternoon, good evening, folks, depending on which part of the world you are dialing in from. As Ekant mentioned, my name is Ike. I'm the SVP of Strategic Partnerships in the Washington, D.C. area at KiwiTech. Super excited to welcome a fantastic panel discussion with Joe and Min, my two fellow panelists for today. If they can both turn their video on, perfect, and also turn their audio on. Min is joining us from Paris, France. Joe is joining from Austin, Texas. So super excited to get perspectives from both sides of the Atlantic. The funds they represent are also different in nature. And so I would love to start today's discussion with a little bit of background. Maybe Joe, you can start, and then Min, on to you. A little bit of background on yourself, the fund thesis, and what it is that you guys do. So, Joe, take it away.
Sure. Well, thanks for having me. Excited to be here. Joe Magyer, Seaplane Ventures in Austin, Texas. Some would say it's the Paris of Texas men, in case you've ever wondered. Um, Seaplane is focused on pre-seed seed investing in the US. So we're typically looking for software companies, e-commerce companies, marketplaces. We are not an impact-led firm, just to manage expectations, but social responsibility, DEI are definitely big considerations for us at the firm. I guess from a perspective standpoint, tend to focus very early here in the US, but just for a little background, I used to manage a large bit of money in Australia for many years, and I've got experience from the perspective of not just dealing with high net worth investors in America, but institutional investors and consultants in Australia. So hopefully that provides some context and perspective.
Wonderful. Min?
Yeah, thank you for the invitation. My name is Min. I have worked about 30 years of VC, and about 10 years, 15 years ago, I started VC as a service, which is basically running funds for corporates. I have two funds right now looking at impact. The first fund, it's an early stage fund looking at social impact around prevention, health, and financial prevention. And the second one is focused on late stage around industry tech, where the investment theme is to scan for mature technologies and offer them to scale their operation in Europe, if they have no factories and so on. So it's more factory builders. I looked at impact investing because of my LP. I have made it clear that under EU regulation, an LP cannot invest in your fund anymore if you don't do you have a clear view on what is impact investing and how you run about it. Yeah. So happy to talk about it.
Sounds good. Wonderful. Well, folks, let's dive right into it. So overall, the venture capital market, if we start there, obviously has seen a huge drop between 2022 and 2023. Overall financing in the US dropped about 30%. Global M&A dropped 20%. Infrastructure projects pretty much came to a halt. The sustainability part has been no different. And I'll post this link from Forbes from last week, just kind of describing some of the stats I just mentioned. Put it here in the chat window so everyone can see it. And so you'll see, again, this is where the sustainability market was private equity was like, but again, venture capital, early stage, late stage is very no different. Again, excited to have this discussion with my fellow panelists, folks on the call or on the Zoom rather. If you have any questions, please feel free to put it on the chat window in the Q&A as well as use the chat feature. Let us know that if you're addressing it to the general panelists or specifically Joe, Min, or myself. Same thing for those who are this is being live streamed to, whether on Meta or any other platform. Feel free to post your questions there. The team will share it with me, and then I will share it with our audience. So again, well, let's just dive right into it. First question is, in the background of what I've just shared, would love to hear from the both of you, kind of your thoughts on impact investing and how have you seen that landscape evolve over the years? Maybe if we can get started with that.
You want me to start, Joe, or you want me to take a shot? Okay. So about 10 years ago, it was good for a fund to follow some SDG goals and just to put into the slide was good enough. But that was it, right? About 5 years ago, it was good to have an ESG score, which is basically a note that you get from any noting agencies and so on about how your fund is doing. And it was very easy because you just answer some qualitative questionnaire, and that was it. But it was not enough because ESG scoring was more the reduction of negative impact. Basically, you are not using paper anymore as a bank, right? And it was not enough for investors. So nowadays, if you raise a fund with institutional investors, insurance company, banks, or the sovereign fund, not only they will ask you for your ESG scoring, what is the number of female, in your partner level kind of thing, but they also ask you for impact measurement. So impact measurement, it's not the reduction of negative impact, it's more how to increase positive impacts. So in my example of a bank, instead of using paper, they want to know if the bank has launched a product that have increased or decreased financial inclusion, or increase the number of unbanked to have a banking account, some kind of thing. And therefore, if you have a fund, you need to actually incorporate non-financial KPIs in your metrics. And LPs are asking for that under the SFDR, which is this European regulation around sustainable finance disclosure regulation, where you have different level, and now we reach the highest level where you need to put some metrics when you invest in a company for your investors. I can go deeper at the later stage.
Oh, that's great. I mean, I'll say I probably won't add anything as far as the definition of impact. I think broadly, I'd agree with that. I think it's probably a good consensus around it. I think Lens's US side of how this evolved, and probably Australia too, there was a slow burn for a long time with ESG, with DEI, which DEI probably wasn't an acronym people had heard of until probably 3 years ago. And all that really accelerated post-COVID. And I'd say a couple of major trends that have been driving that. One has been, to Min's point, institutions and consultants have cared deeply about ESG, sustainability, or ESG, SRI, DEI. These are all different things, but they care a lot. And I've gone through a lot of these RFP processes where I'm dealing with, large allocators, consultants, and they're asking very direct questions about your firm and your underlying portfolio companies, right? So just echoing what Min's seen, I've seen that too. And the companies, the allocators, the venture firms, public equity firms that are putting this money to work, that are getting that pressure, they're the ones that are moving markets at large because they're deploying such large amounts of money, and they tend to set the tone for the industry. So I don't see that long-term mega trend going back. But one thing that I am seeing a lot of is there's a lot of pushback in the US, particularly politically, around each of the groups of acronyms that I just talked about. And I'm not gonna, I'm not trying to make any kind of political commentary here, but it's a fact that there is a lot of political wrangling now around some of these topics. And you got states like Florida and Texas, where I happen to live, that are pushing back, in some cases outright banning the state's funding from going into managers or allocators with certain policies. Given the politicization of a lot of these topics, it's going to be a hot potato. But I think the underlying trend is going to continue to be in the direction of investors caring more and more about that. You see it with younger investors, and as they become more prominent allocators themselves, I think they'll have more of a voice with this going forward.
Awesome. And we'll come back to the theme, Joe, obviously with the election coming up towards the end of the year, kind of how does, in your view, and I think, Min, is there like several countries in Europe that are also going through their election cycle later this year? So I think this is going to be a very interesting year. So would love to also kind of see what the impact could be on the venture capital funding for startups. So we'll come back to that. I'll post another link in the chat window. Within the sustainability space, I think this is much more around kind of climate and what's happening there. And again, you'll see that what I mentioned a little bit earlier, very similar pattern to what we're seeing in the overall industry. So this is more around climate or specifically sustainability, but the stats are very, very similar. The funding was down, 30% from 2022. Deals were lower. If anything, late stage got more love than early stage. And so just a fantastic report. Would highly encourage everyone to see the summary on the website, as well as maybe even download the report. One very interesting find, Joe, again, going back to what you were saying earlier, that government funding was a major contributor in these private rounds. So that's a very interesting takeaway I found, that of the top 10 rounds, 4 received government funding over the last 2 years. Redwood Material got a $2 billion loan from the Department of Energy in February 2023, and then Vercor got a $717 million grant from the French government in September 2023. And so, just some very, very useful insights on what's happening there. And I don't think the broader ESG industry or, again, sustainability is that different. So my question with the two of you is, and again, maybe Joe will start with you and then go back to Min, is how do you think about, how impact investing is collaborating with startups to make sure that they are aligned with their kind of social and environmental goals? There's a bit of a tension there in the system, right? We're achieving optimal return for LPs as far as the GPs is concerned, but then at the same time, there's a mandate, right, that they have to follow, maybe strictly through numbers, or maybe, not in a quantitative sense. But how do you see kind of that conversations happening with startups that, kind of alignment with the social and environmental goals?
Sure. I'll probably speak here to like the very early end of the spectrum. So as a VC, I think it's really important, like any allocator of capital, for your investors and LPs to have a very clear understanding of what your priorities are. So to that point, for me, like my investors have hired me to deliver them performance. So that is top of mind. However, I know them personally and I know their preferences. And so when I'm looking at companies, sometimes I'll occasionally come across something that possibly from a performance standpoint, I think this could work, but I happen to know that a good chunk of our LPs would have an aversion to investing in it, and they just flatly would not want to be involved with it, and it's a pass for me. So that's one way that it kind of flows through the process. One thing I'll say, when you're looking at pre-seed seed and thinking about like SRI, I think it needs to be woven into the model, like fundamentally with the business, if it's going to be up for discussion. So like, I'm not going to talk to one of our founders about like, are you offsetting your emissions by buying carbon credits? I'm talking to them about product market fit, like the failure rate when you're a pre-seed seed is so high. I feel like unless your business is geared around fundamentally something to do with ESG, SRI, EI, like to some extent, some of this is a luxury that you come back to after you establish product market fit. It's not to say it doesn't all matter, but if you're a founder who doesn't have product market fit, I would probably focus on that before, for example, being like, hey, we reduced carbon emissions this year by, X. You're like, great, but you're probably going to run out of cash in 3 months.
Got it. Min?
So first of all my LPs need to follow the EU rules for impact tracking, right? So there's no choice. So impact investors, there's 2 types of deals with startups. The first type of deal is deals that are startups that are in social impact, right? So an app that could save life by making a call, kind of thing. So that is very easy to do impact tracking, because you can ask them how many lives you saved. It's easy in their mission that they want to be in that kind of field, right? So that's the easy part. The non-easy part, right? The ones who are more financially oriented and they are not in that kind of business. I don't know, fintech in asset management, right, kind of thing. So here they are not into the impact world, and you have to force them to look at and think about impact measurement, which is like a challenge. So there's 2 ways to do it. Either you do it at the level of where they are, right? So an asset management, tech is actually doing that at that level of carbon and whatever the credit and so on, or they have to think through how they're going to do it with their clients or customers. And so there is a process where you need it. So how to incorporate that? So first of all, in the due diligence, we do a ESG due diligence to check, and we make some recommendations. So we also are measured by our influence of helping them to create impact KPIs in order to do that, and that's what we've been doing. So it's not for everyone. It's not so easy sometimes to force them. And GPs, many GPs do not care because their background is to make money. They look at the carry, so they don't want to do it and so on. But more and more LPs are asking that, and they put part of their carried KPIs, non-financial KPIs. So I don't know, if you have a 20% carry, some people will ask you, from half to 25%, that non-financial KPI will be part of the carry. So they force the GPs to actually look at impact tracking for their portfolio.
That's a big chunk. I know not everybody here would realize, but yeah, that's a big stick as an incentive.
Yeah, in Europe as well, GP that are serious about impact, they also say that half of the carry will be put into the foundation. The foundation will sponsor, different fund. So that's one way, one trend, but those are the so-called labeled impact investing funds. But you can be a normal fund. Still, you still have to generate impact tracking.
Awesome.
Yes.
Awesome.
I realize that Europe it's maybe a bit more strict than the US at this stage.
Sure, absolutely. So what advice do you have for startup? I mean, how can they best prepare for this process? Joe, one thing I heard from you was, don't try to, it almost sounds like don't try to force fit the ESG or the SRI, metrics. Either you are or you're not. Do still focus on how you can deliver optimal return to your investors. That's, I think, a really, really good advice. Which I think folks should take note. But kind of other advice for startups on how to prepare for the process. What else are you looking at during the due diligence process if you're coming in with that lens or that framework? And let me maybe now start from Min and then go on to Joe. Reverse.
Yeah, sure. I can give you a 3 level of so if you are CEO of the company and just you want to be just find a label, right? So a lot of people are doing B Corp label, and therefore they follow up a certain process, they get the label, and you have many of them going forward. That's a very first level. You have the second level where you want to have AG scoring. So there's many platforms worldwide to do that. So one of them, a worldwide platform, is called EcoVadis. What they do is they do ESG scoring for 1 million companies, right? So you just contact them, you have a contract, they send you some kind of questionnaire, you answer the questionnaire. It's all qualitative questionnaire, and based on the questionnaire and the benchmark on your industry and so on, they give you a note, right? It could be A, B, C, D kind of thing, and so it gives you a sense of where you are compared to the industry. The third, and you can use an impact tracking platform. So when we started this business, we benchmarked worldwide. There's about 6, 8 of them. Most of them are founded by foundations in the US, Denmark, France, and so on. The one I invested, it's called Impact Track. So what they do is they take you from, like a CRM, they just take you step by step to what to do, what kind of metric you could do based on your business compared to other, how it's linked to SDGs. And at the end of the day, they issue an automatic report for you. Because to do IG tracking, impact tracking, you need 3 things: a set of data, number 1. Number 2, you need to have a methodology that is actually approved by some kind of entity, worldwide body and stuff like that. So there's this kind of methodology called Impact Management Project. MIMP, there is a good methodology And many platforms have digitalized it, so you can do it only online. And then you have some data visualization, reporting and so on. So you get the data set right based on certain KPI on the methodology, and then you can actually have some output for your LPs, investors, shareholders, and so on. Those are the 3 steps that you need to do for good impact tracking.
Yeah, I guess from the early side, call it pre-seed seed, kind of tie back to what I said before, I'd say unless ESG or SRI is like woven into your business model, your products, your services, your solutions, like, and you're talking to potential investors at pre-seed seed, like, don't try and greenwash what you're doing, and just focus on the core of what your core product and what it is you're trying to raise money for. Like, you can come back a little bit to some of that later, but unless you're talking to a firm that is very specifically impact first, you're probably gonna confuse an investor if you're really leaning into that as your main thing. And I guess general advice with fundraising, know your audience, right? So if you're talking to an impact-led firm, be prepared for that. If you're talking to a firm that's not impact-led, but they still seem to care, then speak to both. Speak to, your potential for product market fit, TAM, et cetera, but also speak to the other aspects of business that you care about, that they care about too. Just make sure you're prioritizing.
Awesome. Good. I'll go on to the next question. What can the investing community do, in your view, to actively contribute to educating both their fellow investors as well as startups? And let me throw in our elected officials around the principles and benefits of socially responsible investing. Keeping in mind that some of that audience might be unreachable because they refuse to hear anything to do with socially responsible investing or really anything else, But for the folks maybe who are open, would love to kind of hear your thoughts on kind of what we can all do as investors, but also startups to educate that audience. And Joe, again, going back to what we were discussing earlier, and the reason is that, and this is, I think, what makes socially responsible investing so interesting, with all other verticals, fintech, deep tech, biotech, there are nuances, later payoffs, patents are more important, there are other nuances that come up, but I think maybe this regulatory hurdle, or maybe again, to be politically incorrect, these current culture wars, I think, are playing a big role into some of the impediment when it comes to socially responsible investing. So let's talk about it, right? Let's instead of like maybe beating around the bush, let's discuss that head on. What can we do to kind of educate folks on some of the principles, benefits of what socially responsible investing looks like?
Yeah, I think the education and benefits part is well understood by a lot of Americans. So I think from an end investor standpoint, particularly younger investors, they care about SRI and they care about DEI, and they want those things impacted. They want that to be reflected in how they invest. And there's pressure on allocators to affect change from that. And there's top down from institutions and consultants. So I think there's plenty of action there. But there could definitely be room for more of it. And I would say, there needs to be some education around some of these topics that probably flow back in terms of economics and some of the positive economic change that can come from it. You're not going to win over the governor of Texas by talking about who, we produce a lot of petroleum here. You're not going to easily win over the governor, with an enheartened ESG pitch. You need to go into it talking about, the jobs that could be created with putting up, new types of energy in ways that, states could be involved with that and growing the economy. And I think trying to tie back the dollars with people who are skeptics or haters or doubters would be effective.
Min?
So on my side, that my the institutional LPs want me to do impact tracking. I have also another category, the family offices, and so in the beginning, 10 years ago, they were not very caring, but I see a clear trend that the second or third generation of the families are now looking into the matter more seriously. So now, when I talk to the son or the grandson of that particular family office, the topic is more on the top of their mind. So it's easier to convince the younger generations than the later generations on the LP side. And on the startup side, obviously we don't want to go to invest in the startups who have cash flow in 6 months, want to do social impact and financial inclusion, but have no business model. Now we try more to look at the more profitable startup or industries and so on, and try to convince them to incorporate impact tracking into their KPIs. So the financial work remains the same, looking for high growth, profitable business, multiple and so on. But within the investment and the role at the board level, try to generate, more awareness that needs to be done in order to win customers or to have better views with investors, and then get them to try to follow up a few metrics. So year one, you try with one metrics, and get some, pattern. Year two, 2 or 3 pattern, and then, at the end of year 5, it's fully covered. So it's more this process. So I think it's the role of the GPs to actually influence their portfolio to do that, because from the portfolio side, obviously it's going to be hard unless it's a social impact purpose as a mission.
Fantastic. No, I really like that input from both of you, right? I mean, the fact that young people care about this deeply, and young people are obviously not just current, but future consumers, and that's how they will direct their spending dollars and their discretionary spend. And I think that's kind of a very easy sell, and that obviously cuts across, the political spectrum. So I think that's a very, very good point. Again, in terms of the education across the board, and also education for startups, right? That's a consumer segment that they should be keeping in mind, as opposed to some of the old fogies like us, right? So, okay, good. So with that, we'll dive into the Q&A. Quite a few questions coming in, mostly via social media and over email to our team. Zoom is a little bit quiet, so I do encourage any attendees who want to send in questions on either the chat window or the Q&A window for our audience, but let's dive right into it. So let me just see the questions from the audience. Okay, so have you noted, and this is for both of you, have you noted any notable shifts into particular aspects of impact investing or socially responsible investing? For example, climate, or the other areas of impact, or certain communities that are being impacted rather. Any specific shifts in investor attitudes from maybe going one sector to another within the ESG space over the last 1 year, 3 years? Again, take your pick.
And I can give you only the EU perspective, because
sorry, go on.
Because I don't have a global view. So out of 100 projects that we receive about social impact, about social impact investing, 80% is around the E, environmental, climate, decarbonization, and so on and so forth, right? And the EU taxonomy has been very much into the E as well. So 15% is around the S, social impact, and the EU taxonomy, it's not there yet, so it's coming. And 5% is on the G. It's very rare to see somebody looking at G. There are some agencies and so on. And so on my side, because a lot of people are focusing on the E, I focus mainly on the S. Longevity, how people can die well, or there's an age issue in Europe about senior and so on. So we try to focus on the S side. So social impact fund is more my focus.
I think a trend I've seen in the US is particularly early. So startups that are focused on helping, look, I mean, startups across the board, with the exception of AI, have seen funding drop precipitously. So, it's certainly not unique to companies that are ESG centric or SRI centric to have seen funding drop. But one class of them that I've seen really take it on the nose and lose interest from investors is ones that have products that are B2B, aimed at helping enterprises kind of manage their ESG, their SRI, their DEI, like more social aspects of their business that they might have started caring about, call it post-COVID. And spending for a lot of that in the B2B sense has dried up in a big way at places where they got into it because it was greenwashing. And now that they're needing to trim budgets, that's one of the first places they're looking. So I think it's the startups that are enabling greenwashing are the ones that for a while they were riding that wave pretty well, but that wave has crashed pretty hard recently.
Yep, I think investors are very, very smart people. So yeah, greenwashing or any of that phenomena, might go for a while, but I mean, folks will see right through it. So Joe, that's a very, very good point. And then on your point on AI, I mean, it's fascinating. You mentioned that. I just saw an article yesterday from, again, last week. I just put it on the chat window about what's happening with now increased scrutiny on AI, on the entire ethical concerns, and again, especially when it relates to, disinformation or, just the overall ethical scrutiny seems to be really there for when it comes to all startups, So again, AI could be in any space, but then again, there's that very strong ESG lens, coming in. So there's even pressure there from that one sector, which we think would escape the market pressure, so they see kind of the pushback there. So very interesting. So again, highly encourage everyone to kind of go through these links that I shared. One more thing I wanted to say, yes. So Min, on your point, definitely the part of it, the ESG, being the most notable one. Just kind of reading, some of the statistics here and some numbers. As an example, here in the U.S., the tax plan to Congress that the president presented was one of the biggest elements was majorly winding back the fossil fuel subsidies. So I imagine that probably didn't make Texas too happy, Joe. And then replacing those subsidies with incentives to start producing green energy. And then in addition, the Inflation Reduction Act that the president signed into law, provided the largest federal climate change investment in U.S. history. More than $391 billion flowing into that space, which obviously, makes a lot of investors stand up and take notice. So, just a lot of very interesting facts there. We're coming to end of our time, and I see a few questions now also coming in on the chat window. So I'll take this question from Raj. Joe, will start with you and then work our way back to Min. Question from Raj is, what sort of variables can we include in the KPI which can be considered impact tracking? Can you give some specific examples? Joe?
I'm actually going to defer to Min on that one. I think that's a strike zone.
All right, sure.
So the question is what kind of KPI we can put in the business, right? So it's hard to answer the question. It depends on your business, right? So if you invest in fintech, right, then maybe the KPI is on carbon credits, whatever. How the fact that you use digital, we save energy versus or blockchain versus doing paperwork, and there's a lot of agency that will do the work for you. They will find a way to calculate how you process using digital will save energy compared to a normal process. But if you are into people business, right, prevention, right, or health and so on, then it's easier to measure because you measure, if people have anxiety, less anxiety after they use your product or before, right? So it's really depends on the US. The most difficult thing into impact investing is that there are no standards, right? You need to find your own KPI. It's like finding your KPI as a financial KPI. You need, or the KPI or are very linked to your business. That would be my answer.
Got it. That's a very good point. And I see the other question came from Anthony. It was actually quite similar. So, the question was, thanks for all the great information. How would you go about building impact tracking into a core business system? And I think your answer that you just gave also very, very much applies to that. It depends on the industry you're in, depends on the business that you're building. I mean, so that would be quite dependent. But again, this came in on the chat window at Zoom. Joe, Min, anyone want to take a crack at that, or should we just leave it with Min, the great answer he just gave?
I don't see the Zoom.
It's quite similar. So
Okay.
Good. We'll move on. So one more question that came in over email to our team. What are the key challenges that investors and organizations face when incorporating impact considerations into their investment strategies? And we talked about it a little bit earlier, right? So a question goes on to ask, how can these challenges be overcome? So Joe, you mentioned a little bit, especially when it comes to those LP discussions. I'm curious, kind of how do those play out? Would love to get some insights into that. Whether it's coming from the LP side or from your side, from either side. Kind of how does that?
I think from the LP side, you need to know your LPs, and they need to know what your top priorities are and what they are in order, and how much they matter, and just being very clear and transparent with your LPs and potential LPs around that. I mean, generally you'd say that's true about any brand, but I think that's really important when you're talking about allocating people's money in extremely high risk ventures.
Good point.
So as I said, my LPs is a requirement under EU regulation to have a ESG scoring. So there's no choice for institutional. If you're looking for private companies, private investors, and so on, and that I don't know. It depends on people sensitivity and so on and so forth. So hard to say. But in EU, I think most GPs are going to that direction. Forced by regulation.
I mean, I guess I'd say here, even if you're not forced, if you have a consistent investment process and methodology, just incorporate it. Like, name some specific traits you want to see. So, like, for me, for example, I've got a checklist of positive traits that I look for, and companies I had to tick every one, but I'm looking for diverse founders. I'm looking for sustainable models. And those are things that I actively value and put more weight on when I'm looking at companies. And sometimes it's just as simple as making the effort to incorporate it in your diligence process, but also top of funnel when you're looking for ideas, trying to feed the engine.
I can ask also that most GP, they don't really care about impact investing, because their background is to make money in their financial KPI, so they are not so concerned. And there's a wrong perception that impact companies are not making money, or they're just they're not doing well. This is a false perception, because you can actually target a very profitable company and transform it into an impact measurement company, right? So but that's the current market right now. So I must say that no, that's the mainstream here in Europe.
Sounds good. So we're coming up to the end of the session now. Maybe a quick 1 minute final thoughts, and again, Min, will start with you, then go with Joe. Any advice for startups? First of all, really appreciate you sticking around and hearing our pitches today. We have 6 fantastic companies signed up who will be pitching. But from them, for our audience, we have quite a few startups that are in our audience today. Any feedback for them? Any thoughts for them? Maybe 1 minute, if you can share some thoughts, in terms of sustainability and kind of how what they can do better going forward.
You can contact me after the show, after by LinkedIn. My name it's there. You type VC as a service. I'm there. I'm happy to help any startup looking to scale in Europe or to with the technology, especially if it's industry. And I have all kind of methodology, and also I invested in impact tracking platforms.
Wonderful. And if both of you could put your email address or your firm name or even your LinkedIn profile for our audience's benefit, that would be fantastic. And Joe, just to wrap up with you, final thoughts?
Yeah, just say keep it authentic. If it's a core part of who you are, then own it, embrace it, let the world know about it. But if sustainability is not, then just focus on what it is you're trying to do and communicate that. Just be authentic.
Sounds good. Wonderful. Well, again, thanks so much for that, Joe. Min, really appreciate you sharing your thoughts today in such a candid and open manner. I mean, this is a difficult topic. It's not your run-of-the-mill, let's talk about WAC or DCF models. I mean, it's, but I think it's, from where I am, I mean, sitting obviously in DC and living and working in DC, this obviously is very, very important in terms of, helping this, again, not to get on a soapbox, but, making this a more cleaner world, better world, and just a general pace for we can leave behind for our kids. So good. Again, thanks so much for that. Folks, we have 6 fantastic startups that will be pitching today, coming from all parts of the continent. We have Vancouver, Canada. We have the Northeast, North Carolina, Florida, California, and New York. Companies from New York pitching today. So our fellow investors, audience, would love it if you can stick around, listen to them pitch their companies and their ideas. Good luck to all the companies presenting today. I'll be rooting for all of you. And with that, I'll turn it back over to the moderator. So, Srikant.
Thanks for that, Ike, and our panelists, Min and Joe. That was insightful. And therefore, on behalf of everyone who joined us today, we sincerely appreciate all of the wonderful insights and perspectives shared by you. Thank you again. All right, so now we would like to move on to the next exciting part of the event, presentations from our high-value growth stage startups. And before I announce the startups, let's quickly go over the house rules. So each presenter will get 6 minutes to pitch, followed by 2 minutes of question and answer session with the jury. And after each feedback session, we will conduct a poll for you to rank the presentation and seek investor introductions for the stand-up. There will also be a feedback form link provided to you in the chat feature. This is for our attendees to fill out. Please do fill it out. It helps us maintain and improve the quality of our events. So yeah, don't forget to fill the link. So with the house rules clarified, I'm super excited to introduce 6 of our esteemed startup founders. And in order of their presentations, they are Brandy Day, who's the CEO and founder of Real Hire. Mark Epstein, who's the CEO of Chariot Payments Incorporation. Chris Kozak, who's the co-founder of Dishtree. Mr. Jose Sebastian Torres Garcia, who is the CEO and co-founder of Pro Investing Incorporation. Mr. Garrison Davis, CEO and founder, Little Bob Technologies. And Taras Kravchuk,